interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello, everybody, and welcome back to the Private Equity Podcast. Joining us today is Chris Kenny, co-founder and managing partner of L5 Capital Partners, which is a growth equity firm investing in consumer businesses. Welcome, Chris, and thank you very much for sharing your insights.
I'm glad to be here. Thanks for having me. Perfect.
Well, as is customary, Chris, if you could give us a 60 to 90 second breakdown of you, please.
Yeah, no problem. I started my career early days in corporate finance and public companies in the corporate side of it, and quickly worked my way through a high growth company in the telecom boom phase, .com phase, and just got to see all angles of a 5,000 to 7,000 person company, a couple of layoffs, good times, bad times, really great teams, but really kind of my formation of core memories was enhanced in systems-based, ops-based thinking. So if you think about telecommunications, everything has to work, for all but 8 seconds a year, even though there's all these different devices plugged in all over the world. And so we've kind of translated that logic over time to what were originally passion projects and things I started with my friends, which were, hey, friends from telecom, let's grab a beer and talk about how much we like to work with each other and let's go start a business, and made an investment together. And that's, translated itself into, kind of transforming that ops science methodology over into the consumer space, which, from our perspective, everything is getting more systematic, more machine-based, more software-based. And so our ops science type of focus of making that all connect together really applies to the consumer space as much as it does, an airline or a telecommunications network. And so we kind of just took that early stage learnings from myself and my partners and, started to map it over to areas that we had a lot of passion around, that we thought there was going to be a lot of growth in the future.
Interesting. So what made you go from being operator to investor? What inspired you to make that change?
Yeah, I still think we're an operator in investors' clothing, so to speak. If we can do the wolf in sheep's clothing analogy there, we really do get in and understand the unit models and operations of our business and provide insights from our experience on it. And because we have so much experience there and we collect so much real-time data on the consumer, we can be really active participants in the discussion around how to grow and what is and isn't working. So I think it's just an evolution of the investor, because you see a lot of PE firms expanding their operating partner practice as well as their data sciences practice. We're just doing it from the basis of being an operator as opposed to the basis of being an investor.
Makes sense. So what's one mistake that you see private equity firms or portfolio companies making with unique insight, and what would you suggest to correct them?
Yeah, I mean, it's one that we struggle with as well, although we have a bit of a different approach on it, and that's why we have a large operating team. But putting together the right management teams, regardless of if you're starting with a leader or you're filling in various spots, I just think that process is critical and has to be assessed on a routine basis and very open dialogue around it. And I see that private equity firms as well as portfolio companies can quite often kind of logo shop on resumes of people they want to put together. And that doesn't always, make the best team, right? And so, we really want to find people that are culture builders and have proven track record of putting people together and helping them drive kind of connectivity across the processes, which is, really, where we believe the world has come to and is going to get deeper towards, which is, systems thinking, systems processes, all these little things connected together, so you can track them and drive, improvement in the overall outcome.
And is that, see, you focused on the cultural element. What's some of the things So if I'm, look, obviously we deal in search every day, so I know, the challenge is somebody wants somebody from X, somebody wants somebody from Y. If we're thinking consumer, want a big blue chip background and then moved into private equity, see that world-class process and why not? What have you kind of tweaked and changed in your hiring process to either attract those types of individuals or to bring different individuals into the assessment process? What differences have you kind of implemented?
Well, I think, first and foremost, and this is not, shocking from a private equity perspective, but quite often it can be from a portfolio company perspective, is you have to, bring in a slate of candidates via a recruiting firm, right? I mean, that's just, I think there's a lot of groups, not private equity firms, but portfolio companies who kind of balk at the cost of a search firm. When in reality, the wrong employee can cause 10x the damage of their salary, right? And you're only going to pay a third of their salary first year to a search firm. So, using somebody to help bring a slate of candidates, even if you think you know who the candidate is that you want, is really just critical. And then from there, I think it's really important to have an aligned structure in the process of what are we looking for? So what must this role or person accomplish in their first year, 3 years, 5 years? And are you methodical on the front end and at 90 days, post-hiring and a year post-hiring of saying, are we on that track, right? As opposed to getting into this relationship and, are we, kind of just a frog in boiling water type of moment where we got here and you kind of just know in your gut, but you don't want to go through a process again of a rehire. So I think that that's something that we often find ourselves struggling with, but we try and build in the milestones along the way. Now, that doesn't mean that we're just constantly spinning the turn wheel on our management teams. It's just you need to be aware of it so that you're at least having the conversation, because 9 times out of 10, you don't need to go rehire. You just need to give the feedback and say, this is the target, right? Are we aligned or not? So alignment is key, but if constantly alignment is unachieved, then you've got to take a different approach, right?
We're definitely selling the search firm world very well, possibly better than me, Chris. So, but yeah, well, obviously I'm going to agree. Obviously, I deal in search, so bringing firms in, but I understand firms want to look at their own options and want to explore their own networks and etc. in that process. Interesting what you talk about is one of the things that I see a lot that firms, private equity firms in particular, miss when they're looking at the criteria and building out your scorecards of the individuals you're looking for. Not only for some of the firms that don't even do that, but once you've built that, is actually looking at what you need now, what the firm needs in 2.5 years, and what the firm needs at exit. And some may say, well, there isn't the perfect candidate that fits all that criteria. And I'd push back and say there's plenty of candidates that join businesses and take them all the way through, and then some of them even stay on for subsequent private equity investments. And I don't think there's enough consideration looking at all the challenges that are coming in to build a full suite of C-suite executives, rather than just looking at, right, what do we need? We're going to do M&A, we're a buy and build firm. We need somebody who's done buy and build. We need somebody who's taken a business to exit. We need somebody who's worked in the product. And they're not thinking about, well, do we need a CFO with its significant ERP experience? Because we've got huge challenges there. We've got 10,000 SKUs that we have to deal with here. So, and looking at what are the potential challenges at 2.5, 3 years, rather than what I tend to find is we look at the challenge of an exit, or we look at the challenge that immediately the business faces right now. I don't know if you would agree or disagree with that.
I agree 100%. I mean, I think really focusing on that, what's the scorecard 3 years out? Because, realistically, almost any role coming into the role, 6 to 9 months in, you're just starting to figure out, like, what should I be, driving here, right? I mean, that's even with a really efficient onboarding process. I mean, I find that the biggest investment you need to make is, the 6 to 12 months of engagement on the front end to set that person up for success, from all the past learnings, because you don't just want to, put somebody into a space and say, go figure out what history might have been here. You want to bring as much history to them, right? And your knowledge of it, acknowledging that your knowledge of it or your lens of it could be wrong, right? And so that's really critical to see at what point does that person take that and start to run and bring, kind of patterns and structures towards some level of that year 3 scorecard, or say, hey, this year 3 scorecard you said it's here. I think it needs to be here. Can we modify and realign here? right? That's I think the most important part. There's typically, a reason why you're, bringing in talent. And you want something short term, but that's I think the red herring, right? You want to see this improve immediately, but really that 3-year scorecard of like, where do we need to be, and are we taking the actions and aligning our resources around that?
And then identifying that and the person that you need, looking for those traits and that experience and driving.
Yeah, and it's just such a different hire. If you need like a performance marketer, that's something that you can define really well. There's very few like people who are setting out to be an undifferentiated service or product in a marketplace. Everybody wants to be 1, 2, or 3, and that requires unique thinking, right? And so almost by definition, you're not going to find somebody who fits that exact spec, right? And so you're going to need to put somebody who's got 80-90% of what you think is required, and then ensure that their blind spots are covered, or you're filling out the team in other ways to support that.
Absolutely, I couldn't agree more with those points. So just firing into kind of L5 and your strategy there, you obviously got a distinct niche, which I absolutely advocate for. Any PE firm chooses a space, operates in that space. The generalist model isn't dead, but it's not differentiating. What made you focus on the consumer space?
There's always some element of following your passions on it, and so for us, we had this unique moment where we were pursuing a career in telecom and technology, my partner and I, and but on the side, we were building these businesses that we were really consumers of, but really just fascinated by the amount of consumers that were showing up alongside of us, right? And so we kept thinking about those businesses in our free time, and then one day we woke up with a relatively scaled business. It didn't have 20 million in revenue and 4 or 5 million in EBITDA, and we didn't have an ability to double or triple that business for a couple of different reasons. And we said we should really try these techniques over here, like do it again, right? And so we did it again, and it worked very well. And so from there, we said we need to move to a committed capital structure, right? So it was kind of an evolution, but it was over a course of 8 years, right? So there was unlike the whiteboard behind me, we didn't map this out entirely. But funny enough, how we invest today is very similar to the first deal we did, and it's for very different reasons. But I guess gut and logic made sense, at some level. And look, all boats rise, and to some degree. And when we started down this process of consumers of core power yoga back in 2000, 2001, wellness was very, very, very early stage. And so we're 20 years into that run, and it appears it's going to be a relatively permanent, in my lifetime, macro trend. And so I guess following your heart and seeing a lot of other people there is a pretty good indicator of something that might be going on for a while. So.
Yeah, it's interesting. We just one of the podcasts which will be going live prior to this was Alexander Lokopolis, and he invests in the water industry, and absolutely fascinated by it. And it seems that you've found your passion for your industry, and therefore that's curtailed into obviously the business of L5 Capital Partners today. Yeah, and
look, I just keep showing up at new businesses or unit models where one of my key litmus tests around them is as I go and see store to store, and there might only be a handful of stores, are there a bunch of passionate employees there that I didn't believe could be as passionate as they are about the thing they're doing, right? And so they kind of are like an employee consumer, right, or an employee advocate and ambassador, and it's just it blows my mind that it just keeps happening. And I think I, should just accept that pattern is reality. And that's kind of what we, look for as we grow.
So keeping on the kind of specialism and the niche sector here, you guys are operating what you'd regard as early stage growth. Why focus on that area? And secondly, growth equities confusing to people in the growth equity space, to which space they invest in. So how do you define early stage growth?
Yeah, so I'll take the latter first, but for us, early growth is unit model is figured out. it is not, typically we're looking at mature industries and emerging industries. And so we have a different approach for the two. If it's a mature industry and it's a, new take on it. So just for example, like take Apple, right? They're rarely first, but they, generally are bringing a differentiated approach to an existing market that they're hoping to accelerate and make much larger, right? So I mean, I'm not saying we're Apple, but like that's a similar approach to a mature market where we're seeing, for example, in the tanning space, right? 30 years ago you had UV beds, right? And now tanning is all natural ingredients. So you've moved from, kind of lab to a Whole Foods, right? And so in an emerging space, so you could see very few unit models. You could see 2 to 10 stores, right? We focus on 4-wall and kind of like local service type of businesses, which we think are difficult to digitize or be Amazoned out of, for example. And so in that space, you're looking at, okay, well, how much scale do I need to achieve here, and putting on a consolidated corporate level of expense to really grow this thing to get on a material growth curve. And ultimately, we're trying to get, past middle market on our exit and into, buyout, right? We believe that there's a lot of returns available when you're not just trying to get, 3 times revenue growth. And I know that sounds a little bit crazy, but if you're going from 2 to 6 units, that actually doesn't enter you into a big enough universe of buyers and multiple arbitrage, right? And so in an emerging space, we need to see more data points because it could be a fad. You just don't know how the consumer is going to adopt this regionally. So we might need to see 10 to 30, 40 stores there, and you're still not typically consolidated cash flow positive because you haven't been able to build out the exact management team you want. I was looking at a sim last night with a high growth concept, 3 units open, and then you go through the corporate layer and the positions in there, and they're based in a very expensive market, and all the staff is about what we would call 1/3 market rate, right, in terms of what they're paid, and so you've got a team that you're like, okay, well, that is basically like a semi-broken tricycle of a management team. Like, we're going to have to make investments here if we really have ambitions to scale this thing. And so you may look at a consolidated cash flow statement and say, oh, they're going to be $1 million positive next year because of this, but you need to make a $2 million corporate investment, and so you're actually negative, right? Yeah. And then as we discussed in the lead up to this, growth costs money, and growth is messy. So that engine of $1 million of positive, but needs a $2 million corporate investment, might be able to install, $4 or $5 million in revenue a year, but you want to get to installing 20 to 25 million in revenue per year across your system or corporate platform. Do you have enough corporate OpEx there to do that, or are we kind of kidding ourselves, right? And so you're constantly looking at those things to figure out, how do we get this great unit model, this great store or local service scaled, right? And are we being realistic about what that's going to cost and how hard it's going to be and how long it might take?
Interesting. Yeah, growth definitely eats cash and makes things complex. And so it looks like then you're getting in that kind of area where it's, I don't want to say post-venture, but it's that. It's
definitely post-venture, right? So what is post-venture,
okay.
Right? Post-venture is, we're not talking about an idea and here's some capital and how far can you get on this idea and can you achieve product market fit. Product market fit has been achieved. They may not be able to describe cause and effect, but hopefully we're bringing tools in our diligence that help us understand that better. And we've done that multiple times. Now, you may still need a bit more product market fit, but you're looking for 10, 15% more product market fit to open up a bigger aperture on the audience, as opposed to, I have an idea, or I'm partway through my idea. I have, customers, but I'm still 10% negative EBITDA margins, right?
Makes sense. Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast. So you talked earlier about your operator kind of led investors and your experience of running businesses and then moving into that model. How do you feel that as a differentiator for you? Does that offer a unique proposition kind of to potential deals, active portfolio companies? What value do you think that brings to you as a firm?
I think it brings a lot. In early growth, we haven't found a ton of highly competitive processes, like you would, see in a just, pure middle market growth or buyout, right? Where you're going to have, a SIM go out to 40 groups and, whittle it down to 10 with IOIs, and then you get, dragged along through dates and timelines. That's pretty rarely the kind of path we're going down. And of course you want to have, a fair bit of like proprietary and reaching out and things like that. But we're often talking to people 2-3 years before we're investing in them and watching them. And if it is a process, the process extends, right? So, there's a 2-month process that's indicated, but it actually drags out to 4 or 5 because our questions can't, be answered, or management wants to engage a bit more on our views on their business, and that turns it away from kind of the peep show of management during a normal SIM process, right? Where it's like you get a 1-hour fireside chat with management, and we're in there, and we actually have showed up prepared, and we're not just going off information in the SIM, we're going off our proprietary diligence, our knowledge of the market, and it creates this almost like, you're in a conversation at a bar with somebody you met, and it's not a romantic thing or anything, but you're just insanely curious. And all of a sudden you're like, holy cow, it's like 2 a.m. Right. And so that is how our conversations tend to go on the front end. And, we tend to, then take that into a more formal, what could this be?
And is that, you mentioned about your deal flow there, is that mainly because of the nature of the way you're operating there? Are you using predominantly intermediaries, or because of those early stage relationships, you're able to build a bit of proprietary deal flow, which I know is a bit of a unicorn in the industry?
Yeah, look, I mean, we're not like, it's pretty rare that we're picking up the phone and calling somebody direct and saying, hey, we like you. We're finding our way into people's networks some way, somehow. But it's very rarely that it's like, we found this thing and we just need to find a way on LinkedIn or Facebook to connect to them, right? It's more like Battleship, right? Where you're drawing like a quadrant thing out. There's, boats on the other side of the screen, and you're just, trying to figure out if you can get something to hit, and you just keep playing on it, right? So we're generally, I'd say 70% of the time, like thesis driven, in a set, like a wide sector, right? And then I'd say 30% of the time, we'll get presented something that we're insanely curious about, and it might have an intermediary. Typically it does, but not necessarily a process, because a lot of what's occurred over the last, call it decade or 5 years, is that bankers have found out how to, move up market, get bigger deals, which that's their incentive with a, percentage of equity raised or deal size structure, right? And so, we're often finding things that we might be a buyer universe of 5 for, right? And might, right? And so we'll get calls from bankers saying, hey, I'll run this intermediary role, but only if I know on the front end that you're thesis driven towards this and very interested, because this is going to be a lot of work, because I've seen the underbelly and all the financials and all the work that's going to be required here. And this is not a typical, like, I can take this to market and close it in 180 days, right?
It sounds like there's a fair bit of complexity to that, which we'd probably expect with the nature of stage you invest in. So keeping on that kind of operator mode, I was looking through your LinkedIn prior to this, Chris, and obviously the write-up on your website with regards to your profile. You've taken an active role in your portfolio companies, which is pretty rare, certainly from a managing partner perspective, but equally from a investor perspective, where you've actually taken chief executive roles at sort of Big Blue Swim, Level 4 Yoga. Obviously, I'm guessing this is coming from the earlier stage of your career where you were, that operator type mode. What is making you, or made you, take these active leadership positions in these portfolio companies? And equally, now you've had your investor hat on, what have you kind of learned from these experiences of being the chief exec?
Yeah. So again, it's a little bit of the arc, right? Of, level 4 yoga was, it started side hustle, and then it became a very meaningful business, and we had to dedicate time to it, right? And so I think that experience is critical to what we do, because it really goes through that like journey of like, I've got this thing, I spend a couple hours a week on it, and I might actually work a shift, right, to be a part of the team and understand it, right, because I'm building out the unit model and whatnot. And then you transition to, I now have a desk in my bedroom, where I used to be corporately in an office, and all of the accoutrement and an assistant and somebody doing my expenses and all that stuff. And now it's just me in my bedroom, right? And we can't necessarily layer on the G&A of an office yet, which then leads you to, okay, now we have an office because we have 1,500 employees, right? So you're on that whole curve, and do you know how to work like your way through that curve, and can you put yourself in the shoes of the people that we quite often are working with, right? Where we're saying you need to be spending more on personnel, but they're still a year, 18 months removed from working out of their bedroom, right? It's your persuasion of like, I've been through this curve is really, really critical. So that was just a natural evolution of, we have a business that has caught wind in its sails, and we have to grow it. And then in the Big Blue moment, we were moving to the investor part of our career. But again, we didn't, in that movement from, let's call it fundless, from CEO to fundless sponsor, right? Where we didn't have a platform other than our operating capabilities that we developed in our first investment. We didn't have a lot of backup plans to, hey, this CEO has to go tomorrow, right? And then, how do you go and insert, people into that process? Now, we have an M&A background from technology and telecommunications, but these are typically larger companies, right? So when you remove a founder of a founder-led company, you've got to have a plan. And so at that moment, I was actually wearing, 3, CEO hats, and that was my third to get added. And I had a 1-year-old, right? And so, things go bump in the night, and we're not just going to let that turn into a negative outcome for our investors, is really what that is. And so we took the approach of, okay, well, we didn't have alignment with this, CEO prior, right? Let's get alignment aligned, right? Let's set a structure up and get some level of a team in here that can drive cause and effect, while simultaneously trying to recruit in, the long-term CEO. And that's actually what occurred there. So Big Blue, led it for a period of time, which was, I think, probably about 2 years. And in one of those years was training the up and coming COO to be the CEO, who's now been in that chair for 4 years, and is going to have a great long run, with that business. And again, we invested in that business when it was 2 stores. They've got 18 open now. They'll be at 40 by year end. And so you'll go from a $5 million revenue business to $120 million revenue system-wide business in the course of about 6 years, right? And that's an arc that you just kind of have to play into. And so I think what's really key there is what were the learnings, right? Is, well, you got to have a bench. You have to have an ecosystem of people who are ready or close to ready, or a structure to go get people into a funnel to get them into that chair quickly, because there are going to be events that you have to solve for in these businesses on behalf of your LPs that you need to be prepared for. Because, now in our role with, 11 different investments, if 3 of them are needing a leader at any given time, there's not an ability for most people in a private equity shop to parachute in and do that and do it well with our other obligations.
Okay, so there's probably about 1 million questions I could ask you after that. So that was really interesting insight. Just looking at, I know there's a lot of portfolio executives that listen now and build a following there, but you were talking there about preparing the COO for the CEO shoes and position. And you talked quite a bit about looking at businesses and preparing for that. Now, that's not something typically we see in PE, or typically I see in PE, because transition periods can sometimes take some time. And if there's anything that private equity doesn't have in most fund cycles, it's 3 to 5 years of time of preparing a COO. What are some of the things that you were doing with that individual, you've done with your portfolio executives, to develop them into the next role, for progression into either the promotion to chief financial officer, CEO, COO, whatever from there?
Yeah, I mean, I think we actually just look at all of our management teams as an ecosystem, right? And that's across many levels, right? That can go from your CMO to your head of ops, right? It's not just COO and CEO and CFO, but I just look at all these relationships as people who we'd like to do multiple investments with, right? And so you've got to actually build a pyramid and be very aware of your talent cycle and capabilities in there, and just know that you can't snap your fingers and hope for the best, by just dropping somebody up. Although I've been positively surprised more times than I thought by promoting somebody who I thought wasn't ready, and turns out they were pretty darn ready. Right. So there's a little bit of, I guess, courage or whatnot required to do that. But the moment that we had that, CEO role opening, we did not have anybody in that bench cycle ready and available to do it the way that our ops method, is doing it. It was, frankly, a really complicated business. I found it to be the hardest business to date that I had worked on, and we were in some pretty complex things previously. And so we knew the candidate profile we needed, and it was not somebody we could just pluck off the street if we wanted to be successful and not find ourselves right back in that chair, 12 months later. So.
Okay, interesting. So on that basis, what from a personnel perspective, what do you see are the three attributes that you believe make a top performer based on the current leadership team and ecosystem you have there?
Yeah, I mean, I try and keep it pretty simple. I start with like a 2x2 of motivation and capability, right? So do I think they're really truly, motivated for what we need to do, or just anything in general? Because some people are just achievers, right? And then some people are passionate for this, right? And if you put somebody who's not passionate for this but needs to be passionate for this in a place where they're just not passionate for them, they're not going to be motivated to take on these expensive, messy problems, right? But then you have other people who are just like, I love running through brick walls, and that's what I do every day. I put myself in that bucket. And then you have capability, right? Are they capable, or can they become capable, right, of that? And we were, chatting about that in terms of, CEOs. You're rarely going to find that person who is just like, oh yeah, perfect, checks all the boxes, capable, right? There's going to be some level of like, can they grow into this capability? And then the next part of it is that, what are their values? What are they going to bring to the culture, right? And I'm not saying that's secondary, right? But you've got to actually evaluate motivation and capability while having a different lens towards values, because it's not I find a lot of businesses which are just values based first, and if you can't match up to the values of the business as it sits today, then you're an automatic disqualification. I find that to be very difficult to assess in an interview scenario for an executive. It's easier, in a more junior employee.
I think if we look at culture and values is one of the assessment areas, which I don't think anybody's particularly, we see personality profiling testing, etc., and nobody's quite come up with the actual proof of performance yet, never mind the DNA of an organization and that fit and that selection process. It needs a lot of questioning, a lot of understanding, a lot of different types of questioning, and something that we've put a lot of investment in, time in to understand both what the DNA of an organization is, but also how we then identify that from the candidate. So it's definitely a difficult process. So clearly very passionate about your industry, moved from operator to investor. So what do you love about private equity, Chris? And equally, what do you dislike about it?
I really, I love being in and around growth businesses. I'm an intensely curious person. And I think there's humans have a lot of patterns that you just have to figure out and uncover, like, what is the pattern here? Right. And so we're typically seeing high revenue growth businesses, but have we actually built the infrastructure under those patterns to truly scale it? I love that challenge. It's a difficult one because typically finding the high growth business, right? Whoever discovers, and because there's the person who invents the burrito, the person who takes the burrito and turns it into Chipotle, and then there are the people who build 100 stores and then 5,000 stores, right? They're very distinct profiles, right? And typically, we're finding the burrito person or the Chipotle person, and how do we really work with them to scale it, right? And do we have the alignment around what that's going to take? And that's something that I'm really passionate about getting better at myself, because we're in this business of we're on our eighth at bat on growing a brand, which is, if you look at a lifetime, how many people get to grow 8 high growth brands, right? And we've got 20, 30 years left of doing this. So we're just really focused on that system of like, how do we do this better? And we'll continue to add to the team that we have here to do that. The things that I dislike, it really, I find that there's a lot of people who won't say no because they want to keep their aperture open as much as possible. And frankly, I do some of that too. And so, again, if we look towards, commitments and agreements with people, we want to be very deliberate around if our gut says we don't want to spend our time here, let's just tell people that, right? And so whether you're an LP or a banker, or a potential acquirer or a portfolio company, it's just better to get to the efficient part of the process quickly, even if the answer is no for now, right? Because that's at least an answer that you can put away for a bit. So I think that's a big chunk of it. I think that people don't want to offend people, or they just want to keep a proprietary funnel as open as possible, as opposed to saying that one's dead. Why is this still on our list, right?
Do you think that's because there's that fear of losing out, missing out on an opportunity, deal flow is difficult? And why do you think that there's that? Why do you see that in the market space?
Yeah, no, I think it's FOMO. And I think that a lot of times like funnel size matters as opposed to like the quality of the opportunities or the confidence that you can execute on your stated strategy, right?
Makes sense. And what are your influences? What do you read? What do you watch? What do you listen to? And what would you recommend to others?
So I spend a lot of time thinking about kind of habits, right? So subscription models and science around them are it sounds boring, but they're very interesting to me. So there's in this world of recurring revenue, right? I think those are just really the most powerful businesses out there. There may not be the one like most powerful business. They're not necessarily permanently Google or something like that. That's a different, transaction-based, type model. But I really love that. So there's a company called Zora who runs the back end for a lot of SaaS companies, where they're actually watching like consumer engagement of various like tiers of product, right? So are you a super user? Are you a medium user? Are you a low user? And like, what actions did we see you take in the last 6-12 months that might lead to you churning? And then they have a, kind of a lot of subscription-based podcasts and information and in that arena that I think are just really fascinating. I also there's a lot of like historical boring like PhD work on consumer behavior and pricing, right? And so just think about like, when you go to the movie theaters, and then a lot of people haven't done that in quite some time, but like, there's like the base popcorn that costs $4.50 that you convince yourself into because there's either you like it or there's the nostalgia of we're at the movies, right? And then you're like, give me that one. And they're like, yeah, but you can get the next size up for 25 cents. And you're like, great, give me that one. And you get the next one, the tub, for 25 more cents, right? And so, there actually is a fair bit of science around, how that was developed. And, there's the, oh, well, somebody is selling this product, an hour away, right? For half the price of this product that's 10 minutes away. Well, the science actually says that the 10 minutes away is going to win 95 times out of 100. But the local proprietor that's worried about losing their customers prices off of the person an hour away, right? So it's I really it's boring stuff, but I get jazzed about it. And I think that the big platforms out there, Facebook, Google, et cetera, they have a lot of in-house science around our engagement on the digital front, and they keep a lot of that to themselves. They share what they need to help grow their businesses and their marketing expenditures. But I think there's a lot that can be done that we're seeing here that we just get insanely curious about. And ultimately, that is the revenue model, right? That drives the growth that you're talking about. So.
Yeah, all that's interesting. I've got a book actually, I can't remember the name, but it's on my to read shelf. I'm looking to the right with my extensive list of books to read that I keep buying. And that's all about that subscription model. And there's a recent book that I read that it was something around 60% of buying decisions are based on when it's not like a brand or something like that, and it's a need and a want, are just based on who responds first. So who wants, I need a plumber, whoever responds, you get my business. So
yeah.
But interesting you're saying there about, made me think about the pricing model of that individual. And okay, well, you might be the first to respond, but does that reflect your ability to be able to respond quickly? Are you therefore charging a premium because you're available? And I think about, I've just moved to an electric car for my sins, but the person that installed the charger at my house was the person that was available on the day that I messaged him, and I couldn't be bothered going for anyone else. And I have no comparison of how much it cost or whatever else, maybe fortuitous position to be in to do something like that. But the reason I worked with him is because he was available. I messaged him on a Sunday and he was like, do you know what, I'm in your area, I'll pop in. And I was like, oh, incredible. And then that's job done. So
yeah, speed to lead probably is leading to higher ARPU, right? So, that's why what the investment in that, kind of connectivity of speed to lead is really key.
That's really, really interesting. So Chris, if anybody wants to reach out and be in touch, how best do they contact you, please?
Yeah, just shoot me an email, Chris at L5 Capital, LFIVE capital.com.
Perfect. We'll stick that in the show notes as well for information. Well, Chris, thank you very much. You've left us lots of insight, lots of things to think about, and I really appreciate the value that you brought here for private equity professionals and portfolio execs. So appreciate that. Thank you very much.
Thanks again for having me. It was great to be here.
And as always, thank you for those for joining us. Should you ever need support with private equity professionals or portfolio executives, please do reach out to me at Raw Selection. We operate all across Europe and North America. If you haven't done so, please do subscribe and you'll be notified of the next podcast, which comes out every 2 weeks. But till the next time, keep smashing it, and thank you very much for listening.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.